Well, let's welcome in, Krishna Sanghavi, who's with us. Krishna, great to have you with us here. Thank you very much for your time. And we also have Robert Sockin from Citi, who's now with us on the program. Gentlemen, both of you, thank you for being here on CNBC TV 18. Since it's a sort of global-driven day, so Robert, let me just start with you first. What is your own sense? Markets, of course, panicked a little bit. Seems like the Fed changed the game. September, and we were discussing this earlier, September data was strong, but the Fed cut. Data is strong now, but the Fed sounded much more hawkish. How would you read this? Is this transient? Will the market settle down quickly? Or there will be some turbulence?
Yeah, it's a great set of questions. And I think what we saw from Chair Powell today is a bit more cautiousness on the outlook related to inflation. Some of that is due to stronger inflation that we've seen in some recent prints, but probably more broadly underneath the surface, it's more some anticipation of some potential upside inflation risk that may come from the second Trump administration when it comes into office next year. I mean, the good news in the background of all of this is the U.S. economy continues to be very resilient, grow very robustly. That soft landing looks very much on track. But I think given that they're less concerned about downside risk to the economy, it's natural that they shift a bit to worried about risk to inflation again. And I think as this is digested, for one, the Fed has signaled additional rate cuts next year. But most importantly, they said it's going to depend on the news on the ground and what happens with the data. And so if inflation continues to move down towards target, and if some of Trump's more inflationary policies are not necessarily put into play, I think you could potentially see even more cuts from the Fed next year. But it's very much going to depend on what happens with the data and what happens with the administration in 2025.
Robert, but considering that U.S. equities have had such a strong run, the S&P 500 is on course to end the year with a 25% kind of gain. The positioning, the valuations are sort of stretched. So what is the base case scenario for U.S. equities, given the restrictive monetary policy that perhaps we could see going into 2025 compared to earlier, and the uncertainty surrounding policies? Robert?
Oh, is this for me? Sorry, I thought it was other guests. It's a real challenging environment potentially to navigate the equity landscape. On the one hand, as mentioned, we have a very positive growth backdrop in the U.S. Earnings growth has continued to be very strong throughout the cycle, and our equity strategist base case is that you'll get a significant leg up still from here, somewhere into the mid 6,000 range. So I think, broadly speaking, the backdrop from equities is positive. But I come back to the Trump 2.0 potential risks on the tariff front, in that tariffs not only tend to have negative effects on the economy, but they tend to be very negative for specific companies, especially sectors that are heavily dependent on China, heavily dependent on certain supply chains. And so you could see some challenges in specific companies and sectors, depending on how the tariff landscape evolves. So I'd say, broadly speaking, very constructive overall on equities, but we're watching the tariff risks very closely, both for the economy and for the equity market.
Hi, good morning, Krishna, and thanks a lot, Robert, for staying up for us. Let's come back home then. We spoke about the global landscape. What about the RBI? Out here, domestic people are optimistic that the RBI goes ahead and cuts rates. But now the Fed is indicating that we'll have lower number of rates in comparison to what we were anticipating earlier. What are you factoring in with regard to RBI action here in India?
Sure, I think what you correctly said, global linkage is pretty much relevant on, monetary policy. So to that extent, what happens to India monetary policy, maybe rate cut, is partly linked to US. Our sense really is that we'll have rate cuts coming up in CY25. At this juncture, is really difficult to judge whether it's going to be first half or second half, because let's look at it this way. Data points keep on coming pretty short frequency. Almost every month you got inflation data point, whether it's India or global. Monetary policy mates, typically once in 2 months in India, maybe 45 days US. So some of these things are slightly, difficult to judge in terms of actual timing. Yeah, directionally, some sort of a rate cut support to economy can come in CY25 should be the base case. Intensity is slightly difficult because that's where again the global linkage of rates maybe comes into hurt the markets.
Okay, all right, Robert, what about you? What are you factoring in with regard to central bank action here in India?
Well, I think the key thing to focus on from our perspective is we are looking for rates to continue to move down. Broadly speaking, in India, emerging markets, developed markets, this is a global central bank rate cutting cycle that we're in the midst of for the global economy, with a few relatively minor exceptions. Bank of Japan, Bank of Brazil are in different cycles. But in terms of the major players in the developed market space, the Fed, the ECB, in rate cutting mode, and India is as well. But the key, I think, to focus on is even though the Fed cut rates at their recent meeting and signal a few more rate cuts to come, there's the potential for them to stay higher for longer. Again, coming back down to what happens with the economic backdrop and inflation next year. And if the Fed stays higher for longer, that's going to create challenges for all of these other central banks to ease policy as much as we expect in our base case. So right now we have rate cuts, as I said, broadly coming down across most major jurisdictions. But the extent to which they're going to be able to cut rates depends on their domestic factors, but is also, I think, going to depend on how much they're able and willing to deviate from the Fed. And again, we've seen in the past that the Fed stays high for longer, other central banks tend to rethink the extent to which they're able to cut rates.
Robert, once again, I want to say thanks for staying up. What time is it there? Midnight?
Almost 11 p.m.
Okay. Well, thank you very much. And, it must have been a very long day, starting with, of course, the Fed and the market and all that has happened and questions from clients. So thank you once again. So just one more thing, Robert, with the slightly global, and this is largely US, right? Elon Musk was an important part of not part of the government, but very, very important constituency now. He said he wants to cut $2 trillion in federal spending. I think the consensus is that he won't be able to. There's not $2 trillion to find. But the people also generally agree that, well, if anyone can do it, he can do it. We've got this standoff on government spending in the US, right? The government shuts down on Friday. Now, that has happened many times in the past over the years, and you always kind of cross that hump. But how do you, as a economist, how do you account for something like this? Mr. Musk is on X saying that, well, anybody who votes for this bill should be voted out. You got the administration, Trump, and the incoming vice president wanting an increase in spending now and to be debated and passed now, not in March. So what does it mean for asset markets in the US? Is there a clear view?
Absolutely. I think to me, the most important point is that the US fiscal situation is one of very high deficits for the foreseeable future and rising debt to levels that we have not seen since World War II, and then will soon surpass that level in a few years. Right now, it's forecast to be deficits of around 6% of GDP for the foreseeable future per year. And those are very large numbers. And I think what we're seeing with Musk and Ramaswamy, with the DOGE effort, I think on the one hand, that should be applauded. It's always good to try and find efficiency gains where we can. However, I am skeptical that they'll be able to find substantial cost savings, given that the vast majority of government spending is either covered by mandatory spending, so things like Social Security, interest on the debt, and defense-related spending. The non-defense discretionary component of the budget is only about 15%. And so it's not quite clear where you'll be able to find substantial savings. On top of that, some of Trump's policies that he's proposed, such as extending his tax cuts, they're expiring in 2025, are very expensive. I think he'll find ways to pay for most of it. But the bottom line is, I think we're going to be in a large deficit world for the foreseeable future. And I'm hopeful that we'll be able to get on a more sustainable trajectory, but I'm skeptical that we'll be able to get deficits down significantly, even with the DOGE and the creative thinkers behind it. So it's a challenging environment. That means probably some additional upward pressure on treasuries than you would have otherwise, given that markets have to absorb all of this debt. So I think that's the world we're in for at least the foreseeable future.
Just on US 10-year yield, you think we'll be north of 5% through 2025, Robert?
You know, our strategy team, our rate strategy team has around a 4.2% forecast. That was before today's meeting. But I think if the Fed stays higher for longer, you could get a little bit of upward pressure on that. Again, it's going to depend on how the Fed rate cutting environment evolves and how much people are concerned about the long-term fiscal trajectory and other factors under Trump that gets baked into the longer-term yields. But that being said, I would be very surprised if we ended up near the 5% levels. And I think the factors that are in play that are just not in play to really get to those extent. But we are seeing more upward pressure on yields since the Fed's decision. And if we get a lot of inflationary type of policies out of the administration, you could see additional upward pressure from there. So it's something we're watching closely. But I think something in the low fours is much more likely than something close to 5.
Because if it's closer to 5, then that's got an important signaling effect on not just, rates around the world, etc., but equities as well. Krishna, come in there. I was just looking at something like a Vishal Mega, right, which is listed. 35,000 crores on market cap. This morning it's reached 50,000 crores. They did a little north of 600 crores in net profits last year. Say they do 1,000 crores in 2 years' time. It's at 50 times earnings. Now that's a retail business, but just what's your thought on valuations broadly if rates in the US continue to stay? Basically push higher. Robert's saying it's closer to 4 than to 5, but north of 4. But if it's closer to 5, what do you think? What does it do, Krishna, to valuations here, and what kind of businesses?
I think it's the last decade, especially last 4 years of post-COVID, has clearly laid a nice linkage between the monetary policy, the lower rates, higher liquidity combination to the equity market valuations, which is what has led to some of those, excesses of valuation where we look at macro level, maybe market cap to GDP for a country or for an individual sector or company, those, higher levels vis-a-vis the historical past. And let's look at this way, clearly you need finally some, money to buy stocks. And as long as liquidity keeps on coming in, either by a fresh supply of money or, cheaper cost of money, some sort of, liquidity support to valuations is playing out not only in India, even globally. And that's difficult to call whether it switches at half percentage point change in the US 10-year or it's a longer number. And, let's look at it this way. Exactly 2 years back, we actually had a 5%, US 10-year trading. Maybe sometime back it was 375, maybe 360. So those, fluctuations on rates on either US or maybe Indian, they do keep on playing out. The challenge really is, the monetary policy's ability to influence markets on a shorter end has gone up materially. Even if you step back 4 months back, we had a BOJ, event, and the entire market had a nice negative downplay volatility in a just sharp period of 2 days because something changed in the world. In one central bank decides to change the rates, and so the implications on financial market, I think, on this cross rates, cross monetary policy moves are pretty severe, and that's where some of these volatilities are part of it. Stroke, high valuations are perhaps supported by lower cost of money and easy availability of money combination.
Krishna, once again, markets are giving you that near 10% correction from the top. Would you go out there and buy anything in India right now? And what are the big themes going into 2025?
Yeah, I think markets, again, luckily, we don't have to buy markets. We have to finally buy some companies which are doing well or some, companies or sectors where incremental change is likely to be better. So to that extent, yes, some of these, corrections in markets does give those opportunity to start, adding stocks. I think on a very big picture basis, perhaps valuation comfort when I integrate, large cap looks attractive. The only challenge right now is in market is that large cap, while looks valuation was attractive, you got challenge of flows, because FPI flows typically has been negative on, they've been more selling the large caps. So if you look at the flow argument, perhaps, small and mid caps are still getting money in India as from, flows angle, but valuation comfort lies in large cap. I think sectorally, it's slightly difficult in the sense that we've seen quite a few divergences across sectors. In same sector, there are a couple of companies doing exceedingly well, some doing reasonably weaker. So that's a little bit challenging to call out sectors, but clearly, stock specific moves are more likely to dominate at least for next 6 months period is my sense.
Thank you, gentlemen, for joining in. And Robert, once again, thank you for staying up. And Krishna, thank you for joining in. If you don't speak before the year closes, have a good one.
And have a good night's sleep.
Yeah.
And thank you for staying up. I mean, really appreciate it.
Oh, well, he's suited up at 11 p.m., right? That's commitment to work and TV. But let's focus now.